today this is the topic I had planned for almost like I would say a year. The reason is I've been trading myself liquidity level 2 data for a long time, but we have been testing different ways to make it simplify. The reason is if you look at level 2 data, that's very tough to trade because it's not um, highly intuitive. I'll put it this way, because if you have a lot of people uses the DOM, a lot of other tools, but it's very fast moving. It's not able to trade very easily. You can't even make a sense of it by the time numbers moves very fast. That's why we wanted to find the better way to present, better tool to have, so that I can explain a little bit much better. Now we are at the places where I traded personally. It's in the level 2 data. We refined the product. We refined it to the extent to where it's ready to share with a lot of traders. And then I want to teach in terms of how we have been using internally, and then some of the important things you to know, some of the things you might know but you never realized how to use it. So let's go to that. Let's talk about how to trade real-time level 2 liquid data in particular. Okay, so before I get started, please understand the risk involved, as well as today's presentation is all about educational purposes only. I'm not here to talk about in terms of we're not trying to sell any instruments or any financial products, but also understand, do not trade the amount more than you can afford to lose, because trading is risky. Anything we show you, or even like anywhere, not only here, in trading in general, anything past results or simulator performance does not guarantee anything in the future results. But we are going to show you, we always based on the previous repeatable data, but please understand the risk. If needed, go through buysideglobal.com/disclaimer. While you have any questions in the presentation, please, you can message me in the question section. I might not able to answer immediately, but definitely I'll get back to you during the webinar or end of the webinar. Sometimes as long as the question is related to the presentation today, for sure. You have the email address and phone number. If you have anything that you need a clarity on after the webinar ends, please, you can reach us via email or phone number. This was even though I have only 4 bullet points, but I'm going to cover a lot more. I don't want to put a lot of things here. In general, I'm going to show you the power of level 2 data, liquidity data. I want to give a little bit of background, and then I'm going to talk about what is the expected liquidity and then the actual liquidity. Again, this is one thing I wanted to stress a little bit. We'll go through that in detail, and also once we go through the basic information, I'm going to talk about in terms of how to trade it effectively, why you should trade with it, what you are missing out. I think that's the most important part. Of course, we're going to finish with the special offer for the attendees. The product we have been fine-tuned, perfected almost like a year now. We'll go through that in detail pretty soon. All right, so I think I'd like to have the webinar a little bit more interactive. The reason is that this is a perfect time for you to test your own trading knowledge. Okay, because sometimes a lot of traders come to the webinar, most of even our webinar, there won't be any answers or anything. People quietly listen to the webinar. That's good. That's really good. But how about let's test your own knowledge so that you will know where you stand, where you can improve. All right. Let's start with how many of you know, how many can answer this? What do you know about level 2 data? Why it matters? Why it matters? Can anybody type in the question section or a chat? Why do you guys think level 2 data matters? Why liquidity zones matters? OrderFlow, yeah, but everything is out of level 2. Level 1 is also have an OrderFlow which we use, but level 2 is the additional level of OrderFlow. How it's different from level 1? all the indicators that you use today uses only level 1. I don't think any of you use any indicator that uses level 2. Okay, so the level 2 is something very, very unique and different and very complex, very hard to use. But still, why it matters? That's okay. I think you got it off. Correct answer. It's going to show you the order block sitting in the market. We call it as tape. In the trading world or institutional world, we call it as tape trading. It's a pending orders in the market right now, ready to execute in the pipeline. In terms, think like a whole order flow, all the orders you have, everything from every traders in the world is going through the pipeline. You can see everything in there yet to be executed on different prices. All right, so it's not just institutional order flow; it includes everybody's order flow. That's a bigger because a lot of people think like a level 2 is institutional. It's not. Level 2 is everybody's order flow. But only institutional traders use those numbers and then the order flow data. Now retail traders, they don't. We most of the time we just look at the indicators using the level 1 data, and then we make our trading recommendations in terms of what you call it, simple indicators like EMAs, SMAs, RSI, MACD. It doesn't matter, right? I think these are all level 1 data, data-based. But institutional traders never trade without looking at the order flow. The reason is lot of order flow is the only data that's going to give you that information, what's happening right now, what could happen in nearest future. I'm not talking about 2 hours, 3 hours from now. I'm talking about in the immediate future in terms of how much order coming in, how much of those order flow is like a sell orders, buy orders, limit orders, stop orders, everything we can see, but it's very fast moving. That's why um, it's very complex to read. But the biggest important thing I want to stress is that I can tell almost like 95 to 96% of the retail traders never even use level 2 because they don't know how to use. Okay, so in that case, how many of you here use level 2 data in your trading every day? Is there anyone? Is there anyone here uses level 2 data in your day-to-day trading? Anybody? I don't think I got any answer so far because not me or because that's the reason, because it's that we are not trained in those information, even though it's very valuable, very complex. The reason is we don't know how. That's why we are retail traders. Institutions have the most complex systems, algorithms that can interpret the complex data in a visual format, right? That's why they are using those data. You guys heard about like high frequency traders. So their full complete algorithm is based on liquidity. How the reason is that those high frequency traders, they analyze the order flow data which is coming into the market. They can analyze in terms of how much is the order flow, what price points, how much is the buying pressure, selling pressure. Based on purely on the order flow, they make the fast trading decisions, very, very fast, get out, everything. Okay. And also I want you to understand the difference between active order flow versus passive order flow. Okay. Active in the sense, anytime you place a market order, it will be, once it goes to the exchange, it will be executed immediately. That's very much active order flow. So people can't even see it. The moment it comes to the exchange, it's going to execute before anyone can see it. But what is a passive order flow? In your trading, anytime you place a trade, it not only you place the market order, right? What do you do next? You're gonna have your stop loss below your entry price, and then the target a little bit way up. Those are limit orders. You are giving the permission to the exchange. Anybody can see my order, my stop loss order, my target order, and then also you're telling them what price point what exact price you are willing to execute that stop loss, and then exact price point where is your target can be filled. Once the price goes, it can fulfilled. That means market can see it. Those data is what I'm talking about. The level 2, people can see it. Not only your stop, your target, everybody's target, everybody's stop loss is visible to the whole market. That's why you can see in terms of when you open up DOM, I'm going to show you in a second. But anyway, understand the difference between active versus passive. Active is market orders, passive is your limit orders, stop orders, targets, everything is a passive. That means it is reached exchange. Everyone can see it, your orders, but it is not executed right away. It waits for a particular price point to be reached. Okay. And then market always tend towards liquidity. This is something we know, but we don't know how to use it, how to leverage it. That's what it does. Because think market makers, that's a different topic. I don't want to get into it today, but high level understand that market makers and market tend to move towards liquidity, where one particular price point have a lot of order spending to be executed. That's why they're going to run to. People misunderstand that, institutional traders job is to hunt my stop loss. They are trying to find the liquidity, but they are not trying to hunt your stop loss. If your stop loss in the wrong place, then you're going to become liquidity. That's a big difference in those things. Okay. And also, doesn't matter, it's supply and demand, ICT. ICT is becoming very famous these days, but price action, all the strategies um, should use the OrderFlow data as a confluence. Okay, so let's look at that one. Okay, so we talked about OrderFlow, we talked about level 2, but your trading strategy already it's working for you, or it's almost there. Why you should be worried about liquidity zones? I've been trading for without those level 2 data for a long time. Why should I be concerned right now? Um, okay, so let's look at those things. I listed some of the strategies. The top one, of course, my favorite, supply and demand, because this is where a lot of our customers are. Some traders use trend lines, some traders use moving averages, crossovers, um, MACDs, RSI, and then Fibonacci retracement. Can you tell me what is the most common factor across all those strategies? Maybe it's a very wide statement. Let me go there. So let's look at this is our supply and demand indicator, signals indicator, where anytime we see the yellow triangle down, we say it as it's a short signal. Okay, but if you watched my webinars before, I say that all the time. Anytime the demand broken becomes supply, it's a great short signal. You should take a short trade, place your stops above. Okay, so when I say that, it's not, this strategy is not something new. Like, this is there for like 50-60 years. We just perfected it because people make mistakes manually, everything. We just perfected it. That's why it's working for a lot of traders. That means not only you, not only me, like thousands of, or even like millions of traders using the same strategy. What does that mean? Everybody is gonna have the stop almost like right here, right? So that when the lot of traders doing the exact same thing, that means it's great liquidity. Lot of stop orders are gonna sit there. Okay, and also one of the biggest assumption we tell the traders is that anytime the supply zone forms, sellers are coming in. Sellers are coming in, so that they are going to push the price down. And also we tell them when the prices go back to the same level, the sellers will come back again, push the price down. Okay, what does that mean? What does it mean? We are assuming there is a resistance in this area based on the algorithm. Based on the algorithm, say it is a resistance area. Anytime you can see it's a supply, support. Okay, so let's look at the next one. So trend line. anytime we see a trend line traders, the way they trade, anytime the price goes back and touches the trend line, this trend line acts also as a resistance line, right? We heard this so many times. We heard this so many times in terms of resistance. What is resistance? Okay, first of all, what is a resistance? That means sellers are coming in. The more sell orders are coming in. That's what resistance means. But where is the proof? Where is the proof that in the previous slide I said there are a lot of resistance, a lot of sellers are sitting here? When we say it, algorithm works perfectly fine. We can see that here. This is from Friday. They perfectly work. Anytime the signal, it's working well. But the assumption we made in the supply and demand, there are sellers sitting here, push the price down, and then we say sellers are sitting here pushing the prices down. Let's look at the moving averages. Anytime the prices bounces on the EMA 50, SMA 50, again, which we assume this is like used like widely. Oh, that's the it retouched that 50 SMA 50. That means we have a excellent resistance that good to go for a long. Sorry, short in this case. But all these cases have one thing in common, because supply and demand strategy, trend lines, moving averages, everything is assuming that there's a support and resistance touch points, right? I think that's one thing you guys need to understand. We are assuming there are sellers in the area, increasing sellers on those areas, so I can go short. But what is the proof? How do you know there are really sellers? We are making a big assumptions every single time. It works. It works. All these have a one thing in common, is the big assumption that we are assuming there are sellers here. Once we get the signal, yes, go down, but this assumption works only if truly the sellers are interested in this price point. All right, so how do you get those confirmation? How to get the confirmation for you to know the buyers and sellers are in that particular price point levels? Okay, this is where you look at the level 2 data. Okay, this is the super DOM. This is like a, I'm not you I don't know how many of you have level 2 data. If you have level 2 data, if you open the super DOM, these numbers moves very, very fast. In terms of, by the time you see it, numbers keep on changing like, I don't know how to explain. Because the order flow comes and goes, and like it changes the numbers every single nanosecond. The market is streaming with all the order flow. Today, compared to like 30-40 years ago, people supply and demand, all those things, now we are in the technological peak, meaning we can see all the data, all the orders, everybody orders around the world on this particular instrument, right from a desktop. But the only problem is this data is not like easily usable. If you open super DOM, you can see all the prices. This price, we have this many orders pending, limit orders. Every price point, we can see all the limit orders, everything. Okay, but you can't really make it effective. By the time you try to analyze it, the numbers are changing. Numbers are changing very, very, very fast. That's why the liquidity zones. That's why we created liquidity zones. What we do, we converted the important high wall, because that means in this price, there are limit sell orders, 435 contracts, 231 contracts. Okay, anytime we see higher liquidity, concentrated orders, limit orders there, we want to see those things color coded. Higher the contrast, higher the number. Lower the contrast, look at, you can see the 231. Look at how is like a less contrast versus the 435, very high contrast. We color coded everything, and also if you notice, we ignore the noise. The if you look at mathematical standpoint, I am from mathematical background, so mathematical standpoint, we need to look for the outliers in terms of, if you look at all the order flow, anything in this case, the median is 100, 150, median or like a midpoint. But we don't want those things. We don't want to be charting those things. We want to see the outliers, the biggest liquidity, highest orders pending to execute. So why it's useful? Why we need to see those things? Okay, so I'm going to show you that one in a minute. Okay, but if you try to put all the order flow data, try to visualize that chart, you can see that every single order flow, different numbers, but it does not make any sense, right? I think it's too congested. That's why we try to change different ways, customize it a little bit to make it a little bit um, legible. So let's look at this is a supply and demand indicator, signals indicator we have. When we mark down these levels, supply and then the demand, we are telling them this is strongest supply, this is strongest demand, implying, assuming that there are sellers here, there are buyers here, and the sellers are shifting here, buyers are shifting here, and also there are huge sellers even below this buyers. There are huge number of buyers are sitting here. There are buyers here, buyers here. That's what we're telling. We are trying to convey in these supply and demand signal indicators. Every time it's working, but it's the algorithm is predicting. But how can you see actually? Sorry, excuse me. Actually, the buyers are really there. Okay, now same chart, same data. I want to look at level 2 data now. Okay, this is the same day. I took this snapshot from the same day. What you can see right there, you can see these numbers. This is this green that I marked. This is converting these numbers, analyzing those numbers, finding out the highest pending orders, right? So highest pending orders. We analyze those data. We try to ignore all the noises, trying to find only the outliers, and then try to same supply and demand signal on the chart on the same day, same chart. If I try to attach the liquidity zones, you can clearly see the top supply, the sellers. You see this? Don't confuse between actual sellers versus stop loss. These are all the pending limit orders. It could be the stop loss for the traders who entered short here, but all these higher the contrast, higher the sellers in this area, right? So, and then you can see those green. If you look at the, since I said the same exact chart, I said there are buyers here, buyer was taken down, it shifted, and also I said there's a huge bias here. Look at how much the supply and demand zone into signals is agreeing completely with actual real-time order flow coming from level 2 zones. Can you see that that is additional bias sitting here, huge number of chunks, and then there is a huge bias here was taken down. Do you see this in terms of how exactly it's matching? This is what we call as confluence. And when you say confluence, supply and demand indicator is working only on the level 2 basic order flow, and then trying to predict the better supply, better demand, giving you the signals, giving you the areas, everything. But moment when you turn on the level 2 detailed lowest level order flow data, when you see exactly it's matching, that is no better way to get the confluence, right? So that's why it's very important you to know, look at the level 2 data to see whenever there is a bias or a large number of buy orders here, sell orders here, then you will know. You don't want to get caught in the no man's land. That means nobody's trading in this place. You can see it's all like no green, no red. In these areas, you're going to get killed. If you're going long or short, anywhere in the no man's land, look at any no man's land is the most vulnerable area. Do not take any trade in those areas. Okay, that's most important takeaway from here. You need to know which places is you are alone. That means think about it for a second. When you are taking the long trade, what do you want to happen? When you are taking the long trade, what do you want to happen? You want the market to go up so that you can make money. But market will go up only when the buyers are stepping in, more buyers coming in, and then pushing the prices up. When you are alone, you are not. It's not going to happen. That's why I said, in terms of know where are the most buyers are interested in terms of when the market moves. Stay along with the buyers. Always stay. Uh, when there are like a lot of sellers, we don't want you to go long. When there are a lot of buyers here, we don't want you to go short. Know exactly what is the real time order flow, what is actually happening. This is not based on uh, in terms of predicting like SMA, EMA, or like VWAP. Oh, you touched that price. Oh, that means sellers are coming in. It's just an assumption. There is not actual proof that the sellers are there to take the market down. The real proof is in the order flow, level 2 data, because there you can see the which price point exactly, where you can see highest number of sellers or a buyers. You need to join the majority, okay, and the exact price point. That is the goal. Are you guys with me? Am I confusing or what do you guys? Am I making it clear or am I making it confused? This is a complex information. I think it will take some time to understand, but I want you to understand the basics of what is level 2, why it's important. Know the difference between most important point versus like expected assumption based support, because trend lines, EMAs, VWAP, supply and demand, or like any strategy that you trade today without level 2, all the algorithms are predicting the sellers are coming in, buys are coming in. It's only predicting. There is no actual proof or confluence. Okay, that's why we try to pair the supply and demand with this. Why? Anytime we see the supply and demand is the levels of bias, we say it's there, is agreeing with the exact order flow, what's happening in the real-time market. That's a great way to confirm for your conference. Okay, so this is the level 2 data from NQ. Okay, I want you to, I know it's confusing, but to start with, please note down one thing. I want you to focus only on the order flow which you marked here, persistent. That means the line started, keep on extending, extending, extending. Focus only on those extended lines. Okay, why? Those are persistent order flow. People determine the price, they're going to stuck with the price, they are not going to move it. Okay, so that's very important. And then you can see when the price moves, there are dots, there are small prices, green lines. Ignore those things. Those are noises. That's you and me, actually. This is you and me, where we keep on moving the stop losses, everything. It does not have any persistence to it. All the short-lived reds, short-lived greens, or just you and me, retail traders, just try to limit the loss by moving the uh, stop loss or targets along with the market. But institutional large order flows, they stay. They know the price, what they are willing to buy, what they're willing to sell. They are persistent. Look only at those things. Okay. Now here's a fascinating part. If you have attended my training, or if you have supply and demand trading signals, if you watch the training videos, I say that again and again, one particular strategy you should always trade. What is it? Who can tell me that answer right now? What is the one strategy that we recommend in supply and demand you should always trade with a high confidence? Can anyone answer that? Come on, guys. Someone. Because I'm trying to show you the confluence of that particular strategy right here. Okay, I didn't get any response. My God, I should do better job in terms of training. All right, so breakout, yes, breakout, but breakout and switch. I tell you, anytime, let's say, anytime there are strong demand, let's say there's a strong demand, there's strong buyers here. Look, once it's broken and a supply forms, didn't I say that in the videos? Didn't I say that in the supply and demand, the trading signals? We have one algorithm, top algorithm. We have 5 algorithm, right? So top algorithm is specifically look for what? Break and retest and then swap. So what is it? What does it mean? Anytime the price is breaking out the strongest persistent demand, here the green zones are the buyers. Take it as demand. Broken, look at the same price level, the supply formed. Sellers are stepping in. Didn't I say that that's the greatest way for you to have your trade? Same thing. When the supply was here, extend, persistence broken, and then the buyers coming in. This is exactly confirming the supply and demand signals and strategy that I've been training for almost for a long time. But you can get the confluence right here. Okay. That's why I'm saying anytime it's broken, you need to wait till the opposite signal form. Look here. Of course it's a demand line. I tell them just because it's broken, don't trade it immediately. You need to wait for the signal. Look at what happened. It came down and then went up. Can you tell me what exactly happened here? When there's a strong demand there, price came just right to it and then went up. This is exactly we talked about. You guys heard about it, but you guys don't know what it is. Liquidity hunt. Like I said, liquidity hunt means market makers try to see which price points we have the strongest buyers or sellers. They want to come down, take the liquidity, and then try to fill the orders above. Take the liquid. Look at this again. Second time, the strongest demand just came down to take the liquidity, execute, take out all the stops here, and then go up. Come down, take out liquidity, and went up. Every time, if you follow our strategy, supply demand trading signals strategy, just because demand was broken, don't take it the trade. Wait for opposite zone formed. Look at here. It was broken here. It didn't go up. Instead, it started forming the opposite zone. This is why you can see how the market actually executing the live orders, your order, my order, everybody orders in the live. You can see that in the screen right now, but you need to have the level 2 data. Okay, you need to have the level 2 data. That's very, very important. Okay, and also one more biggest limitation. The biggest limitation we have in level 2 compared to level 1 is level 2 do not have historical information, meaning when you come in the morning, attach the base liquidity zones to the chart, you'll see nothing. Because usually when you attach indicator to the chart, what will happen? You'll see previous bars are painted and the indicator also showed the data, everything there. But why? Because the level 1 data, we get historical information. Level 2, no. That means when you attach the indicator, you'll see nothing. But as the time progresses, as the data coming in, it started painting the data. In this case, you can see in the morning when I started, like I think 8:40, 8:50, I started my chart. Before that, there's nothing, no information here. But once I started the chart, I waited, it starts painting. Because remember that we looked at the OrderFlow data before this information. As the data start coming in, the algorithm in the liquidity zone start painting the information for you to take a better decision. Okay, and then I have more samples. Okay, so more samples here. This is the NQ from the 15th of May. This is the choppy day, the whole part. But even though it's a choppy day, always we get the good opportunities. Like what? Look at this. There is not much activity in the market. It's very, very slim. But look at here, the supply, demand, market is bouncing between those things. Once it's broken, same price point, the buyer stepping in. What does it mean? This is a great trade for you to go. If you could have noticed that if you attach that May 15th, our supply and demand signal, you can see the supply was broken and the demand zone forms, the signal would have marked. This is a greater confluence. In terms of also one other bigger important reason you should use is you can move your stops below those actual buyers in the market. Okay. All right. So one more, we saw that May 17. That's the one I showed before. Okay. Um, I'm not going to cover a little bit more in depth on those things. I will cover definitely those things. I'm going to produce a detailed training video in the coming week for all the traders who purchase the product, liquidity zones indicator. So high level, you need to know what is a liquidity sweep, what is a liquidity run, and then what is liquidity bounce. Let me give a little bit high level. Anytime there is a liquidity, market comes, sweeps it. That means takes a liquidity and then goes back. You can liquidity sweep trade. Again, it's a liquidity sweep trade, right? And then this is liquidity run. That means it broken, but it's not bouncing back. So there's a three different scenarios you need to always learn. Okay, look at here. There's a liquidity here. Market did not go. It bounced. Liquidity bounced those areas. So we'll go through that in detail later. But learn in terms of the three important terms: liquidity sweep, liquidity run, liquidity bounce. You need to understand those terminologies. Sometimes when you hear first time, it's a little bit too much lingo or like confusing. But if you start seeing the chart again and again and again, same thing, you're gonna learn very, very fast. That's why I tell all the supply and demand traders, you need a screen time, short screen time, one instrument, one setup every day. Every day, you're gonna get better and better as the day progresses. Same thing for liquidity. Okay, look at this. This is a fascinating day. Look at how much the buyers the whole day. Look at this. I think it's highest order of buyers are sitting there. It's market pushed, push, push, push. Look at the markets did. They swept the whole liquidity and then pushed the market up. This is why I say you need to know the market liquidity sweep, liquidity run, everything, so that you can trade on it, right? So if you look at the same day, May 20th, if you attach supply and demand trading signals indicator, you will see it was broken down and then another went back up again, and then you see the signals after it bounced. Okay. Anyways, let's move on. Another example here in terms of the from May 28th, liquidity zones. I think I opened my chart a little bit late, 10:50, not early morning. And then you can see the sellers are there, buyers are staying here in terms of same thing. Buyers are broken, sellers formed, market goes down. Same way in terms of finally sellers broken, buyers forming. Every time you can see the extended buyers here broken. You can see those opportunities right there. But main reason you have to use level 2 as a confluence. Whatever the strategy you're using, um, supply and demand, or like whatever it is, when you make a decision, you're going long or short, look at level 2. Is there, or the sellers are coming in? Sellers are coming in, or where is the liquidity? Okay, you need to know this information to add a additional confluence. Okay, this is another data from May 29, the whole day choppy day. But look at the persistence buyers, persistent sellers are there in the market. In between are just the choppiness day. Even a choppier day, this is going to give you the actual market range where market is going to be staying in, right? So that's why even on a choppy day, I think it doesn't matter. This is a great way to add a confluence. All right. So again, I wanted to reiterate in terms of understand between expected liquidity versus the actual liquidity. So when we say expect liquidity, anytime the supply zone forms, we are telling you, algorithm says there are sellers are stepping in, you can go short and then place your stops here. You can look at same chart and liquidity zone, see, oh, are the really sellers are there? How? You can see those lines. You can see those lines. You can see those actual liquidity zones. Or when I say liquidity zones, when those sellers are stepping in, they are going to leave the stop loss above the trade, right? So these are not like actual sellers. Sellers are, when you see this red zone, that means sellers are somewhere here. They have the stop loss here. They have that's what it means. It's a limit orders pending to be executed. Okay, So that's why I say understand the expected liquidity is supply and demand or EMA or a VWAP or whatever it is. We are assuming there are sellers stepping in the particular price range, but it's always helpful for you to confirm the same in terms of information, looking at the liquidity data to see actual liquidity, actual sellers, actual buyers on the exact the price points you can see here in terms of the sellers price point, right? You can see those things. And also, again, I said the strongest supply, once it's broken, the demand forms. Look what happens. Look what happens. Because until it's broken, look at market struggles, right? Look at what market. Once it's broken, and then like a supply become demand, look at what happens. This is why it's always look for the confluence actual data. Okay, so this is my code. I wrote this. If you do not aware of the nearest liquidity zone before you enter your trade, then you will become, sorry, not your, you will become the liquidity for the institutional traders. Okay. I don't know how to explain better, but I try to say, I was thinking when I put in the slide, I want to convey the thought why, how to simple way. If you do not aware of, if you put your stop loss, if you trade enter your trade anywhere, then you become the liquidity. That means there is no way for you to protect your trade. That means there is no, when you are taking long trade, you have to join the huge buyers interest so that you along with them can push the market up, right? Then there are a lot of sellers in the market. When you go buy long, what's going to happen? You'll be crushed. You will become liquidity for the traders. Please don't become liquidity for them. Okay, so stay behind the liquidity, join the direction where they are. I was trying to, when I add this quote, I was trying to find what is the better way to explain this. Okay, maybe it's cheesy, but hear me out, don't laugh. I put a diagram. Okay, so let's say these are all the sellers. Okay, the selling interest and then the buying interest. When they are, and then you are here. Okay, this is this icon is you. When the sellers are start coming down, you are alone. You will be crushed to death. Okay, that means it's easy. That number of order flow coming in, sellers interest coming down. You are alone here. You'll be crushed, and then once it actually reaches the buyer's interest, it's going to bounce. Okay, so how many times you have seen you entered the long trade, but it came down, took your stop loss, and then market moves long, went long. These are the reasons. These are the reasons you need to look at those things. Now, instead of this, I want you to do exact opposite. Okay, hide your stop behind the liquidity. That means see the highest liquidity zones, highest buying interest, buyers there. Hide your stop behind them. Why? When the sellers are coming down, started pushing, trying to push the market at a price point, buyers are ready to step in. That means if you hide your stop behind that buying interest, there's a better chance. There's no guarantee. Trading, there's no guarantee, but there's a better chance these buyers might push this, overcome the sellers, push the market back up. My point is, hide your stop behind the liquidity. Okay, and also my other point is, if you do not aware of the nearest liquidity zone before you enter the trade, then you will become the liquidity for the institutional traders. Okay, all right. So again, this is May 29th. Okay, so we came to the end of the presentation. BSC liquidity zones is indicator that we have perfected almost for a long time now. I've been using it my trade internally, and as I picked some of the traders as well in the team to use it for a long time. Now you can use it. I'm going to give you the settings for each instrument. It's different because the outliers numbers are different. The settings will be different for ES, NQ, CL. I'll share everything. You can get the indicator in the website.